Hello, everyone. Welcome to today's Milliman webinar. I'm Richard Payne, Director and Consulting Actuary in Milliman's life insurance practice in Hong Kong. We've got people dialing in today from across the globe, so good morning, good afternoon, or good evening, wherever you are. Thank you for joining this session today, which covers three topics related to climate risk. Today's webinar is presented by the Milliman Climate Resilience Initiative, or MCRI. The MCRI is made up of actuaries, financial risk managers, geospatial consultants, and others who are focused on modelling, measuring, and managing complex risks associated with climate change. The goal of the MCRI is to create cross-sector conversations across insurance, industry, government, and community organisations in order to help anticipate and measure these climate risks and drive effective responses. This is the third and final event in the MCRI Around the World webinar series. As we're all aware, the effects of climate change are being felt across the globe. Our previous webinars in this series examined climate stress scenarios in Europe, and we also had a session on the impact of climate risk on insurers in the USA. Today's webinar focuses on climate impact in Asia. In the last couple of years, some regulators around the region have started to enhance their oversight of climate-related risks and are increasingly pushing insurers to do more work on this topic, including requiring climate stress tests to be produced. Today, we have three presenters that will address different angles of climate risk in Asia. First, Erica Chan from our Hong Kong Life Insurance Office will provide an overview of how Asian regulators have responded to the climate risk challenge. Then Ken Lim from our Malaysia Non-Life Office will dive deeper into stress testing requirements and alternative methods used by non-life insurers for managing climate risk. Finally, we're very grateful to have Michael McCord, who's the Managing Director of Milliman's Microinsurance Centre, that is dedicated to developing risk management solutions for low-income people. Michael will consider the issue of climate risk from the perspective of low-income populations in developing markets and discuss whether microinsurance can help to mitigate the risk. In total, we've got 90 minutes scheduled for this webinar, but we should have plenty of time for questions. Microphones will remain off throughout the session, so please post your questions in the chat box and they'll come to us directly. We intend to address your questions after all three speakers have finished their presentations, but feel free to type your questions into the chat box as they occur to you, and we'll pick them up at the end. The webinar is being recorded, and the video will be posted to the Milliman website afterwards and available to stream on demand. Now, let me hand you over to our first speaker, Erica Chan. Erica is a principal and consulting actuary in Milliman's Hong Kong life insurance practice. She has extensive experience in risk management and actuarial modelling topics in the life insurance space in Asia and Europe. Erica has authored numerous Milliman white papers on climate risk, risk management, and capital management topics, and has presented these topics at industry and professional events. Erica, over to you.
Thanks, Michael, for the introduction. It's my pleasure to be today's first presenter for this webinar. Hello all, and it's my great pleasure to also have you to be my audience today. In the first part of the webinar, I will have a very brief overview on the climate risk management and stress testing requirement in Asia Pacific. However, before we step into details of the regulatory requirement, I would like to ask everybody short questions, although you can answer it using your chat box or even maybe in your mind. Why we should really care about climate risk? Is climate risk really an issue at a financial perspective? I think we watch on the newspaper or maybe COP26, 27, all these government scientists are claiming that the world should recognize climate changes as an emerging risk. And if we don't do anything in the next 10 or 20 years, maybe we will have a very climate catastrophe at the end of this century, or maybe in 2050. It seems to us that the changes, even it is already quite obvious in recent years, but the real impact will happen, say, in 10 years or 20 years later. So why should we care about that? Indeed, for example, as a life actuary, I don't really think that maybe the mortality or morbidity rate will double in the next 3 or 5 years, right? So, however, if you look on the internet and then you read the recent news, you can find that there's more wildfire. Indeed, the Environmental Protection Agency in US already observed that in recent years, the length of the wildfire season and the severity of the wildfire has increased in recent years because of the changing climate. And also in this year, the World Meteorological Organization has also claimed that July 2023 is said to be the hottest month in record. And as you all know, extreme heat is deadly for human beings. So instead of thinking a climate catastrophe which happened 10 or 20 years later, maybe we should even start thinking about it now, because something that already happened in recent years. Indeed, climate change, not only when combined, even other factors like the climate policies, like what the reaction of the regulator, will have an impact on not only on the community, but also on the financial perspective of the insurance companies. Most regulators, just like what Richard has introduced earlier, has already taken some actions. Globally, we have a organization called NGFS, which is the full name is Network for Greening and Financial System. It's a group of central banks and supervisors who voluntarily set up this network to exchange and share best practice among climate risk management. And hopefully they will in future they would due to sharing of best practice, they or maybe sharing what is the most update, we will eventually achieving a set of best practice guidance for how to manage and measure and climate risk. Indeed, NGFS is also an organization to public climate scenario, which are also used by a number of regulators in their climate stress testing exercise for their industries. Indeed, Mr. Joaquin Menon, which is the managing director of the MAS, which is currently chairing the NGFS. Indeed, MAS is the regulator of the Singapore financial sector. So, in one of the publications in 2019, NGFS already emphasized that climate-related risk is a source of financial risk. Indeed, and therefore, it should be within the mandate of the central banks and to ensure the financial system is resilient to this climate risk. And in 2021, NGFS also surveyed 31 members of the network. It is found that all the members of this network is either planning or in the progress of doing climate stress testings for their own financial system or financial sectors. 4 of them even complete the climate stress testing by 2021 October. And in the survey, it also pointed out that all respondents has included their banking sectors into this climate-wide stress testing. However, only 50% of those include insurance as part of the climate stress testing exercise. You can see that in central bank and supervisors' perspective, climate risk is a key risk and really need to address for the financial sector as a whole. But how about specifically for insurance industry? IAIS, which is stand for International Association of Insurance Supervisors, also claims that climate change is widely recognized as a source of financial risk. It echoed with the statement that NGFS made earlier, and insurers are quite exposed to climate-related risks in their asset and liability side of the balance sheet via their underwriting and investment activities. So therefore, it is regarded as one of the key risks that insurance companies should look at during the risk management and risk assessment process. And insurance company can also act as a key agent in identifying, mitigating, and managing climate risk according to IAIS. And hopefully, we can contribute positively towards a sustainable transition to net zero. So you can see that indeed IAIS also promote insurance regulator to take into account climate risk into their mandate. Indeed, in Asia, quite a lot of insurance regulator has already started looking into climate risk and see how they can incorporate them into one of the regulatory guidance, or some of them even require industry to participate in climate stress testing or issue quite a lot of guidance for the industry to take care of their climate risk exposure. In the next, I think 10 minutes of my presentation, I will quickly go through some of the key developments in a number of jurisdictions. First of all, I would like to go to Singapore first. As you know, Singapore is one of the most advanced jurisdictions that in terms of climate risk management in Asia. In 2013, I think MAS has published a ERM guideline for the industry, and in this ERM guideline, it just emphasized the industry should take into account emerging risks. Indeed, no particular focus has been put on climate risk management. However, in 2017, MAS has published a guidance on OSA. It's explicitly mentioned that insurance company, if you want to qualify as a sound risk management company, you need to take into account climate risk as one of the key emerging risks, and in particularly, you should put more focus on this in order to fulfill so-called a good risk management practice. And in 2020, it even published a guidelines on environmental risk management for insurance company. So it provides further guidance for the industry to understand and to assess their climate risk. It also emphasized that companies should take into short-term, long-term environmental scenario in assessing the climate risk exposure and the climate impact on their balance sheet and P&L. In 2021, a Singapore regulator has started asking the industry to consider climate scenarios in the industry-wide stress test. It's conducted annually, and in 2021, it starts with a short-term scenario. And in 2022, the Singapore regulator even requests the industry to conduct the stress testing using 3 hypothetical scenarios for a period of 2022 to 2050. Includes and you can see that the regulation become more and more detailed in Singapore in terms of climate risk management, and also it's more and more requirements are expected in the stress testing side of the Singapore regulator. In Malaysia, I think you will see a relatively similar story as Singapore. In 2021, it has the regulator in Malaysia, BNM, has published a climate risk taxonomy paper. It serve as a guidance for the financial institutions to categorize their economic activities based on their climate objective, and it also helped the industry to assess the climate risk. And in 2021, the regulator even had even published a specific paper for climate risk management and scenario analysis. It has stipulated the principles and requirements on managing climate risk. And scenario analysis should be used as one of the key tools to understand the climate risk exposure of the companies. And in 2024, the regulator has scheduled an industrialized stress testing, which should be applicable to the whole insurance industry. It has issued a discussion paper and a feedback form so that the industry can feedback on the key elements that stated in the discussion paper in relation to the 2024 climate risk stress testing exercise. And it is also expected that all the insurance industry, the whole insurance industry, should take into account climate risk in their ICAP process starting 2024 year end. In Taiwan, it's a little bit different from the other two jurisdictions. Stress testing has been conducted in 2021, but however, it's mainly focused on non-life insurance industry, and only a few typhoon scenarios are covered. And in 2021, the regulator has requested the industry to embed climate risk management in its ORSA process, and and also in the ORSA report, you also need to state your climate risk management practices and procedures and your policy, etc. And in your ORSA report. In the same year, the regulator also issued a disclosure requirement for the insurance industry. It is required by the regulator that the industry should release their climate risk, the climate-related risk, risk management procedures and risk management practices and their scenario analysis, etc. in their sustainability report or on your company website. So you can see that Taiwan is also increasing their regulatory oversight in the climate risk management through ORSA and through disclosure. Although there's no industry-wide stress testing requirement for the whole insurance industry in the near future. In Japan, I think the story is quite similar to Taiwan. The stress testing done in 2021 is not industry-wide, but it includes 3 banks and 3 non-life insurance companies. It's 3 scenarios are included in the stress testing exercise called net zero, delayed transition, and current policies. However, there's no life insurance company are included in this stress testing exercise. In 2022, the regulator has issued a super risk guidance on climate risk management. However, there's no further requirement on ORSA or others extra requirement on a stress testing for the whole financial sector in near future has been announced. In Hong Kong, I think we are in. I'm from Hong Kong. I'm from Hong Kong office, so we are quite, I would say, a little bit behind the curve. In 2019, we have the insurance regulator has issued a guideline on enterprise risk management. It explicitly requests the insurance company to take into account emerging risks, including climate risk, as part of the ERM process. In 2021. For those companies who are under the group-wide supervision, indeed 3 big multinationals are covered under this guideline. They are required to produce annual disclosure on the approaches and the potential impacts for climate risk. In 2013, the regulator would like to understand more about the current practice adopted by the insurance company to address climate risk. Therefore, they have done a survey on climate risk management in June 2023. And we are waiting for the result and see how, and the regulator, based on the result, is expected to issue further guidance or guidelines on climate risk management. Yeah. Today, because of the constraint of time, I'm only able to cover a number of the jurisdiction. However, as a whole, when compared to Europe, you can see that Europeans regulators are leading in this aspect. Indeed, in Southeast Asia, currently it's the Singapore, which is leading in terms of climate risk management or industry-wide stress testing for climate risk. Other regulators are following suit, we can see that these regulators often have prescribed scenario, and indeed you can see that we are a little bit behind the Europeans. However, in the near future, we will expect that we will see more and more developments in terms of climate risk management, and more requirements should be on like climate stress testing or disclosure for insurance company operating in Asia. Thanks. That's all for my presentation today.
Great, thank you, Erica. So if you've got questions for Erica, can you just drop them into the chat box and we will address them at the end. So having had a brief overview of the regulatory developments across Asia, let's dig a little deeper into stress testing requirements on the non-life side. And I'll hand you over shortly to my colleague, Ken Lin. Ken is a senior consultant with Milliman's non-life team in Malaysia. Ken has extensive experience working with insurers in Southeast Asia and Greater China, as well as his work on multiple statutory reserve reviews, appraisal valuations, and M&A due diligence. Ken has significant experience on the risk management side, including conducting reviews of ORSAs, financial condition reports, and enterprise risk management frameworks for clients across the region. Ken, over to you.
Hi. Hi, thank you, Richard. Hi, everyone. Good afternoon, good morning, good evening, depending on which location you're coming from. So in the next 30 minutes or so, I'm going to share some of the case studies that we've seen in terms of stress testing, specifically in the non-life sector, how different players, with different sizes or different level of complexity within their group or within the company, what sort of things have they been doing, and then we'll take a step backward and see what other pragmatic steps that you could take or has been taken in the industry, right, to address some of the shortfalls or address some of the gaps in terms of stress testing. So without further ado, I will move on to my next slide, right? So before we deep dive into the stress testing and what people have been doing, right? Perhaps it's a good idea to look at two big camps of approaches when it comes to stress testing for non-life companies. I categorize them into two different camps, right? So on the left-hand side, it's event-based scenario. So typically stress testing under this camp, it will be linked to a specific event, right? For example, link it to a 1 in 200 flood event, link it to the 2011 Bangkok flood event, link it to the Peninsular flood event. It has some sort of resemblance or reference to historical losses. And the upside of this approach is that it's easy for the insurance company or for the insurers because they know the losses, they know the reinsurance impact, they know the bottom line deterioration because this is something that they have seen it. But of course, under this event-based scenario approach, the downside is that it's very challenging to link it to climate change, because what has happened in the past, right? We are talking maybe as dated as 2011 is definitely not going to be representative in 2050, which often is the time frame where the regulators want you to do stress tests on, right? And of course, another downside of this is that the results or the experience is individualized in a sense, right? Depending on your exposure at that time, or depending whether you are insuring a factory that is in the epicenter of the event, right? Your losses is very different from other companies. So I might get scarred a little bit. I might be in very, very bad trouble because of the same event. So it's not comparable in a sense. So with that said, we see that there is another camp of stress testing. It's more towards the change in parameters. It's, we're talking about changes in severity, frequency, correlation parameters for the perils. Like, what happened if the temperature rise by 2 degrees Celsius? What happened if the flood or what happened if the sea level rise by 1 meter, right? It's more standardized, it's more accurate, because these are the real factors that drive, the climate change impact. But of course, the downside is it's harder to model, right? Looking across the region or the world in terms of stress testing, there is a tendency for the companies, or not for companies, sorry, for the regulators to move towards this approach, right? Including EIOPA in Europe, they are moving towards the change in parameters approach. So the change in parameters will be the way forward, the way I see it, right? Event-based scenario, although it's good, but slowly regulator will move towards the change in parameters. And also, another thing to talk about is that these stress testing scenarios, often when we look at the guidelines issued by the regulators, right, they are all coming in similar way, even though the regulators like to package it or name it differently, but it has some sort of resemblance, towards the popular sets of scenarios suggested by Networking for Greening the Financial System, NGFS, which Erica has made an introduction about. It's often about orderly transition, disorderly transition, no additional policies. For those of you who don't quite know what these scenarios are, a quick introduction, right? So orderly transition is assuming that by 2050, the temperature, all the countries will take the necessary steps to slowly control the increase in temperature, at 1.6, 1.5. Whereas this orderly transition, it means that, okay, for the first few years, we do nothing, but then after that, we realize that, okay, we are not meeting our target, we'll do drastic reaction in order to catch up, and then eventually we will still meet the target, and no additional policies means we don't really care what's going on, we continue our life, right? So all these are the scenarios, and come with these scenarios, you have different parameters, you have different physical parameters, right? Sea level rise is different under orderly and disorderly transition. Precipitation is different between disorderly transition and no additional policies. Of course, some of the regulators, they will go one step forward. They will tell you what are the changes in terms of financial parameters, like the GDP of the country will go by this much, the carbon price will drop by this much or increase by this much. So now, as insurer or for insurers, the question is, how do we translate all these things into P&L, right? That is the question that everyone has been asking. Like, okay, I know what you gave me, but I don't know how to put it into stress testing, because to stress test my P&L, I'm looking at my premiums, my losses, my expenses, all right? So that is a challenge. So, okay, now in the center of the whole stress testing, right? Modeling catastrophe losses is the biggest element, or one of the bigger elements, I would say. And we did modeling catastrophe losses across the region or across the industry. We see that there are different level of sophistication, right? Depending on where you land as a company, right? At the top of this, we have catastrophe modeling involving a CAT models, which I will go into later, right? But for those who doesn't have a CAT model, we see that we rely more on this approach called a plug and play approach. Essentially, what it means is that I will ask my reinsurance broker or my reinsurer to run some sort of analysis for me as part of the service or value add service when I do my treaty renewal each year, right? And then the good thing about plug and play, of course, is that it's relatively easier because the third party is doing it for you, and you get to know the impact of the reinsurance costs better, right? So in between the two extreme of modeling catastrophe yourself and asking someone to help you, we also see that there are some interim steps or interim methodology that some companies are trying to explore, right? So they are trying to explore some event-based scenario with some sort of modification to tailor for the climate change impact. And then there's also a more statistical approach using the Bayesian modeling, not as complicated as CAT models, but still some sort of modeling. So I will go through each of these methods right later on, and then we try to see what are the pros, what are the cons, whether this would be an alternative framework that you or your company could consider moving forward. So let's move to catastrophe models. So catastrophe models, it's it can be proprietary, it can be open source, right? But most of the time, it requires the modeler to input the parameters, right? And it will go through 5 modules, hazard and impact, those kind of modules, and then it will give you some sort of 1 in 200-year event. What are your losses? 1 in 50-year, what are your losses? You will see the probable maximum losses from the output, right? So there are some very famous proprietary ones out there. Of course, these ones, they are not that affordable. Sometimes it's expensive. Interestingly, there are some open source CAT models out there as well. So one example is this model called Climata. It's been developed by ETH, the Zurich University, and it's been endorsed by EIOPA, the European regulator. So Climata, it's run on Python. It has a nice interface. It has the data that come with it that you can do some catastrophe modeling on it. But the downside of any catastrophe model is, of course, you need a lot of resource expertise and experience, particularly in parameterizing the catastrophe models. If you don't put in the right model, it is very likely to reach a situation where we have a rubbish in, rubbish out scenario, which is not necessarily helpful in the sense that, yes, we have an output, but the output may not be meaningful, right? And one good thing or something that is worth noting is that the parameters that are required for each of the natural perils, right? More often than not, they're more than what the regulator prescribed. So I give you an example. I'm not a natural catastrophe modeler myself, but based on my understanding, right? Even though under the regulatory scenarios prescribed by the regulator, they will tell you something like, assume that temperature went up by this amount, assume that the sea level went up by this amount, but these parameters that they provide is often not enough to fully model the impact of climate change, right? Say, take flood, for example, right? To model for flood, we need the flood depth, we need parameters like the gradient of the slope, we need to know whether there's any flood defense mechanism put in place, right? So these are the information that are crucial in order to accurately model the impact of flood due to climate change. But more often than not, we don't get the full suite of parameters from the regulator. So they might just give us 2 out of 5 or 2 out of 10, right? Then what do we do with the remaining 8 parameters that are needed? So even though catastrophe models, they are quote unquote the most sophisticated solution in terms of modeling catastrophes at this point, but it's not straightforward. The reliability is a concern, and sometimes even the most experienced users, they struggle, right? In the absence of catastrophe models, right? So as I mentioned, not everyone can afford catastrophe models. Not everyone know how to run a catastrophe models. Then it comes a question as to what happens if I don't have one? What can I do, right? Is there anything else I can use or I can try to explore in the meantime of fulfilling my regulatory obligations in terms of stress testing? So I'm going to show you 3 case studies in the next few minutes, right? These are what we saw, what the market players have been using, right? They are not perfect on their own. They each have downside and upside, right? What I would like to share here is that perhaps these are the alternative framework that you could consider, right? It's an option for you. So the first case study is first example, right, is based on this conjecture or hypothesis that everyone has, right? Essentially, this is talking about, okay, more severe catastrophes are coming at higher frequency, right? So we see that more and more floods are coming, more and more natural disasters are happening. So what we see, some of the companies, what they do is that if they have a loss distribution curve, right? If they have a ILF, for example, right? What they've done is that they assume that a 1 in 100 event in the future, right, is a 1 in 200 event now. So basically, they try to use the same curve, but then they take different cutoff points, right? Assuming that more severe catastrophes are coming at higher frequency. So this is a quick, straightforward way for them to assume what will happen in 2050 under different scenarios. Of course, how do I decide whether 1 in 200 now is 1 in 100 in the future or vice versa? These are very judgmental, right? To some extent, some people might argue that is there any basis behind it? That's debatable, but this typically would serve the purpose, especially if you are small insurers and you wanted something just for discussion or something quick, right? Another example, it's on the event-based modification, event-based scenario, but with some sort of modification. So they are doing it from a frequency and severity perspective. So what we notice is that in the internet, there are a lot of literature being published that they will tell you under if the world temperature increased by 1.5 degrees Celsius, extreme rainfall risk will increase by 50% in terms of frequency. If it is 2 degrees Celsius, it's 70% increase. If vice versa for fluvial flood, for drought, they have all these impact out there. So they will use these published statistics as a guidance to adjust the frequency. Another way that we have seen is, of course, using more empirical evidence. We have managed to found the occurrence of climate-related disaster in Southeast Asia in the past 100 years or so. So on the right-hand side, you will see that storm and flood, they are increasing, the frequency is increasing. So companies will extrapolate this frequency or this occurrence, right? Try to project what would be the amount of flood that I'm talking about 50 years later, 100 years later. And then the extrapolation rate is different under different scenarios, right? So this is one of the methods that we have seen. Similarly, on the severity side, there are also enough public information out there. So for example, on the right-hand side, we have insured losses in the world, right, by different events. This is, I believe, published by Munich Re, right? You can see that the moving average or the insured losses is actually increasing at a rate, and then you can extrapolate the rate in the same time, try to predict what will happen in 2050. On the left-hand side, it's a graph that is quite of an interest to myself. So if you take a step backward and think carefully, right, when we talk about all the literatures in the market, when they talk about the impact of climate change, the impact of the losses from natural disasters, a lot of the time, the losses that are being quoted on newspaper or in article or in literature, they are economic losses. They are not insured losses, right? Insured losses actually made up maybe 25 to 35 or 40% of the economic losses, as shown from the graph in the past 10 years. So depending on what sort of information or what sort of literature you are referring to, if you believe more on the economic losses projection, you can always extrapolate the economic losses you want, or if you believe more in insured losses, you can extrapolate the insured losses. But another thing for consideration is, of course, the percentage of insured loss, which is the black line here. So what we notice is that the percentage of insured loss over time has actually increased or almost doubled, right? Suggesting that the community, the people, is trying to use insurance as a risk transfer mechanism, right? They are trying to transfer the risk to insurer. So it will be important to also take this into consideration when you are doing your projection moving forward. The next example that I would like to highlight here is Bayesian modeling. So this example is first explored by the Society of Actuaries, SOA, in the US. There is a link to the full paper. So to make it in a very layman term, essentially, Bayesian modeling is a very good statistical method to model dependencies. So let's just take the graph on the right, for example, right? So we are saying what we are interested in is what is the distribution of flood impact, which is the one on the top. But we know that the flood impact has dependency. It depends on flood count. It depends on flood cost, right? And flood count, it depends on temperature. It depends on sea level rise. It depends on precipitation. So through this node or these tree diagram, we can try to map out the dependencies of each of the item, right? Down to a level where, okay, I know how temperature will move. I know how sea level rise will change. I know precipitation, how it will change in the future, right? I can do some sort of modeling here. It can be stochastic, it can be deterministic, but then I can assign a distribution and then simulate what is my flood impact. So it's a statistical method. It's an alternative framework. It's also a very flexible framework. If you read the paper carefully, SOA actually commissioned this Bayesian modeling beyond just looking at flood impact. They are actually looking at how climate change will impact the house pricing in Florida, right? So we can use this framework, a portion of it just to do climate stress testing. But of course, we have other options to expand this Bayesian modeling to do other applications and other impact. Okay, now, after talking about so many different methods, so many different pragmatic steps in terms of modeling catastrophe losses, it's important also to note that climate change is beyond catastrophe risk, right? If we look at here on this slide, beyond catastrophe losses, climate change also have mortality risk impact. It also have morbidity risk impact. Take Philippines, for example, right? Malaria cover, it's a big deal. And they do see that malaria infection rate is increasing, right? According to the statistic, we found that close to 60% of the infectious disease have been aggravated because of climate change, right? There are more dengue cases every year, right? These are also contributing to the increase in claims cost for be it the non-life industry or the life industry, right? On the right-hand side, there are also more claims coming in, more from a compliance claims perspective, or some of them call this the liability risk, right? So we pull some examples like in the UK, we are talking about a 27 million fines. In China, there are other 154 million US dollar. So you have a new bunch of claims coming up, and it's not as big as catastrophe risk, or maybe bigger than catastrophe risk, but it's a new risk. So what would likely to happen, right? Whether you are very sophisticated and you bought the most advanced CAT models for your company, is that you will require some sort of method mashup in order to encapsulate the whole impact of climate change, or to model, right, stress testing for climate change, right? You will need two different kind of methods, or plug and play plus event-based scenario modification in the end of the day. Of course, there's one risk that everyone is very concerned or very interested in is, okay, how about transition, right? How about the impact on my balance sheet, right? So just a quick a recap, what is a transition risk? So a transition risk is the risk, that your assets value might be impacted when your company try to move towards the climate change compliant model, right? So you probably have to divest away from, let's say, coal mining shares, or you need to divest away from any bonds investment that is not environmental friendly. Right, in the end of the day, it depends on whether the regulator gives you some sort of economic parameters as part of your stress scenarios. Most of the time, they do, but if they don't, there's enough reference out there, under orderly transition, this is what will happen. Disorderly transition, this is what might happen, right? For GI companies specifically, physical risk and transition risk kind of work in the opposite way. Right, so if we are allowing for bad catastrophe events like the ones that we are modeling for, right, chances are I'm not doing a good job in transitioning. So then there is little transition risk for me, because having a bad physical catastrophe is an outcome of that, right? And also most of the investment classes for GI will tend to be cash and risk-free bond heavy. Right, there are enough literatures out there, right, to tell you how to translate the economic parameters into asset value change. They have different models, Climate-Fin, Karima, PACTA. All these are available in the internet with very detailed explanation on how to do it. Now, in the end of the day, what we wanted to say here is that even though the whole stress testing model sounds academic, sounds very mathematical, right? But what we see, or what we think, is that there is actually an opportunity in terms of this whole modeling thing, as to how we can translate it into something beyond regulatory compliance. Right, how can we use the outcome of all these modeling, Bayesian modeling, catastrophe modeling, how to use these for a greater good to make the world a better place? All right, so we also draw some sort of examples that we see in the market, whereby some of the insurance companies, they are using all these flood modeling or flood initiatives, right, to help their policy holder. Right, they will give them flood warnings, or even for Zurich, they will help the communities prepare for and recover from flood. Where should you build your flood defense mechanism? These are the stuff that, since you already put in so much effort in terms of modeling, where would the flood happen and how does it impact, right? We can use this to help the policy holder, right? And if we take a step even back, forward, right, beyond just insurance and policy holder relationship, we are talking about a wider community kind of involvement. We see a very good case study in the US where there's this thing called the Town of Paradise. It was destroyed by wildfire in 2018. And then when they are rebuilding the township, right, they use catastrophe models together with a reinsurer, Munich Re, together with consultant. They try to determine how and where the housing can be built safely so that, let's say in 2050, with climate change, wildfire wouldn't hit you, right? It will reach a certain point. So if you build it at this place, you are safe, right? So these are the stuff that we see in the market, right? Whereby you use your catastrophe modeling, your statistical modeling for a greater good, not just for compliance purposes. So the message we want to get out here is that, don't think of modeling as a burdensome job or, something just to tick the box. But if we use it correctly and strategically, right, it will be a good means for us to do a greater good to the community, and also a good opportunity for the insurers to get their brand out there, basically, right? So with that, I'm going to end my presentation. I'm going to pass back to you, Richard.
Thanks, Ken. If anyone has any questions for Ken, please type them into the chat box, and again, we'll address them at the end of the session. We've already had a few, so thank you for those and keep them coming. And now on to our final speaker, Michael McCord, who will consider the issue of climate risk from the perspective of low-income populations in developing markets and discuss whether microinsurance can help to mitigate climate-related risks. Based in Wisconsin, USA, Michael is the managing director of Milliman's Microinsurance Center. This is a specialized unit that's dedicated to creating an environment that enables the development of risk management solutions for low-income people. Michael is a highly respected voice in the microinsurance field, having worked in over 75 countries in the areas of research, advocacy, and design of microinsurance products and processes, working for private sector, public sector, and developmental clients. He's a member of the Working Group for Climate Insurance-Linked Resilient Infrastructure Finance, which is a part of the United Nations Capital Development Fund. He's also a member of the Insurance Development Forum's Inclusive Insurance Working Group. Michael, thank you for joining us so late at night where you are. I'm not sure if we're seeing technical issue online. Bear with us just a second. Excellent. Right. Thanks, Michael. Over to you.
Okay. Great. Thank you, Richard. Thank you very much. And oops, I've gone too far already. And so let's all stand up. We've been going almost an hour. Let's stretch a little bit, get the blood flowing so that we can start thinking in a bit of a new direction, or a broadened direction maybe. Okay, let's sit back down now that the blood is really flowing. Thank you. That was it's a bit of a trick. I suspect that amongst the audience, maybe 10% of you actually did stand up, and maybe I'm being optimistic. I think, we talk about all this important stuff around stress testing and all, but I think we have to really think about compliance, and are we actually doing what we're supposed to be doing, and are we doing it in a way that makes sense? And I think this is something that we really have to consider, plus getting blood flowing. But this is really important, and I think part of the reason for that is because, and thank you, Ken, for bringing this to a kind of broader perspective in terms of broadening out where the information is coming, where the issues are coming from. We've done a good deal of disaster risk financing work recently over the last, well, certainly all of this year. And And, you know, one of the things that becomes very clear is that no one entity or type of entity is going to be able to address these climate change issues and these climate change costs. And I think it's important for us to recognize that we need to bring, not just identify the information, not just do the stress testing, but also we have to work with others. We have to share our data. We have to work with the rest of government, private sector, donor community, policymakers. All of these organizations, all of these entities are part of how we deal with disaster risks and catastrophe risks. And so stress testing really needs to happen at your institution, but then it has to happen at a broader level. And we have to think about, what do we do for these other entities, these other levels of government? How do we deal with both the preparation for disaster risks as well as the cleanup and the rebuilding? So I think this is really important. Let's keep in mind that this is part of a component of the broader working. And so I just want to take a quick look. You know, many of us have been talking about the Sustainable Development Goals, and I think it's important for us to recognize some of the key areas where insurance fits appropriately and indeed is necessary to start achieving some of these Sustainable Development Goals. Don't worry, I'll get back to stress testing a bit. But in order to look at these goals and think about this in a broad way, we need to think about how insurance has to happen, has to be available if we're going to stop poverty, if we're going to stop hunger, if we're going to create better health, gender equality, decent work. These things require us to be involved as insurers. And I think this is important to remember, because it's not just the P&L, it's the P&L doing things that really help the world, that help to make sure that we are better prepared and that people are stronger. So I want to talk about how does climate risk affect low-income communities. As Richard said, I'm focused much more on the low-income communities and how we address their issues and make sure that they don't get left out when we have these catastrophic risks. And so I have a couple of examples that just lead us to a bit of a broader discussion. In the Philippines, there was Typhoon Haiyan back in 2013, happened right at the end of the year. And this was a massive, it was called a super typhoon at that point. But we had over 6,500 deaths, 1 million people plunged into poverty. I mean, imagine 1 million people in addition to those in poverty already in the Philippines. 1 million homes destroyed. Now, this actually, okay, 1 million people plunged into poverty. So several thousand, and I recognize that's just a small component, a small piece of that, but several thousand of them were actually insured. The low-income people were insured for typhoon damage. And the regulator, this is an example of how the different entities came together to help to address these issues, but the regulator came and said, okay, we have to go there and we have to be able to distribute this money as quickly as possible. Some of the insurers, of course, were pushing this too. So they rented containers and they turned those into offices very quickly, within days. And then many of the insurers had representatives in the area where the disasters occurred, and they were paying claims already. Okay. And so as we think about stress testing, we also have to think about, how do we get that money there? It's not just, okay, the financial piece, but there's an operational piece that requires getting to people. Now, if it takes 3 months, 4 months to get claims to people who were just involved in a typhoon, that's not helpful to them. So as part of the stress testing, we have to additionally think about, how do we make sure we get the money there? And there are lots of different mechanisms, right? We talk about 3 general mechanisms. There's the micro, the meso, and the macro level that we're dealing with. And as we think about the stress testing and the costs of how do we distribute, what many experts are coming to is that we need to be focusing more on the meso levels, getting the money to an intermediary level that can focus then on the low-income people much more effectively, so that the insurer is not dealing with that. So how do you get the money out? What are the different layers? The macro level, of course, is basically governmental and national-wide, and the micro level is getting money directly to low-income people. We'll talk about that in a moment, how one organization did that. But I think what we're seeing here is very significant issues, very significant problems for a country to have to deal with. And one insurer can't deal with that. You can't deal with 1 million homes destroyed. You can't deal with $12.9 billion out of the economy. Okay. So we have to be thinking about this in a broad sense. Our stress testing needs to go into a broader pocket of information, in a broader pocket of efforts. We should be working with government. It was an earthquake in Nepal in 2015. You have almost 9,000 dead, $7 billion in damage. And oftentimes when we talk about damage, what we're talking about here is the cost of buildings that are damaged, destroyed. But when we have these kinds of risks, the costs are actually much, much greater. There was a program in the Philippines, for example, where they paid for, Insuransi Wahana Tata paid for flood damage based on an index. And they paid funds to help people just be able to buy food right away. This was immediate disbursement and being able to provide food. And so, this doesn't even begin to account for building damage. Okay, so there's a lot of these other costs. And we have to think about that when we're thinking about these damage numbers. What do they really include? In Nepal, this is interesting to me because in Nepal, there was $7 billion of loss, but only 3% of that, which is what, $210 million. So $6.790 billion was not covered by insurance. Now, should it all be covered by insurance? No, of course not. Some of that is going to come from the government through realignment of budgets. Some of it's going to come from donors who throw their money in. Some of it's going to come from other sources, the commercial markets, as we're starting to see more and more there. And so I think that's important to think about, is what of that piece belongs, if you will, to insurers. So as we're thinking about our stress testing, are we able to cover up to the amount that we're covering? Does the aggregate of the different insurers cover enough of this to really make a difference? And so those things, I think, are things that we have to be thinking about. So this is a 3% coverage in Nepal, but if we look at low and medium income countries, 94% of the damages over the years have not been covered by insurance. Only 6% has been. And so I think this is an important consideration. And again, let's not fall into the trap to think that insurers have to cover all of that, because certainly they don't. But what we need is a better structure. And I'm starting to see this in more and more countries where there's an effort to bring together the different parties and start to layer the solutions. And I think this should be remembered, this should be considered, and you all should be participating in these kinds of efforts. I've seen this even in Ethiopia, right? And how do we expect Ethiopia, for example, to be doing this kind of an effort? We should be seeing this in Vietnam and in the Philippines and in some of these other countries, this broader stress testing, if you will, or stress addressing. Okay, so how do we do this? We need to think about, Ken mentioned the fact that when we're talking about these damages also, right, we're talking about often just the component, the compartmentalization of these key points, the damage. What we have to remember is that when there are typhoons, drinking water becomes polluted. Okay, insects come and have more of an impact. Ken also mentioned malaria in the Philippines. We're also starting to get malaria in the United States, in the south of the United States. It's coming back. And, you know, I have my US representative from Wisconsin, which many of you will know is in the very north of the US. My US representative says he doesn't care about climate change. He doesn't care if things get warmer, because if it gets warmer, more people will come, more tourists will come to Wisconsin because it's warm and nice, and people like it where it's warm and nice, but they're not going to like it where it's warm and nice and they can get malaria and other diseases. We have to think about these things, and what are the costs then of these efforts? So when we think about just the disaster component and the property component, we also need to start thinking about how are we going to manage the impact on the rest of our products. Okay, and so microinsurance is where I focus. Microinsurance is insurance that's specifically designed for low-income people, and creating mechanisms that actually work for them. Now, microinsurance isn't some kind of crazy thing that's off to the side. We have to remember, microinsurance is simply part of the continuum of insurance. At the top, you have, you know, your very high level multinational companies. You've got high net worth individuals, middle income individuals, small businesses, and down at the bottom of the chain, you have microinsurance. And so at each of these levels, we provide products in different ways that impact those markets. And so if we're going to scale this in any way that can help with climate change, we need to think about the supply, the demand, the enabling environment. How does everything fit together and work? And then distribution. These four pieces must come together. And so amongst them, when we think about supply, right, we have limited variety. There's very little out there that's focused on how do we help low-income people recover from these major catastrophic issues. We recognize that there's little there. We recognize that insurers can't be generally, responsible for getting the product to the end client. We need to think about these meso-level efforts, but we need to be creating climate-specific microinsurance products or generally products for low-income markets. One of the things that's been really interesting for me is to see the kind of emergence of what they're calling forecast finance. I'm sure many of you, most of you have heard of this. And the issue is, how do we get claims to people before the event even occurs? And so there's examples like in the Philippines, where Global Parametrics and Plan and Oxfam came together, and they provided a product that paid people a day before the typhoon hit. This was a typhoon at the end of the year, I think in 3 years ago, maybe 4 years ago. But before the typhoon hit. So when the money comes a day earlier, then what happens is you have the opportunity to be able to prepare your house for a typhoon, to get out, so there's less death, less illness, and less damage. And so these kinds of things give you an opportunity to do this. And with mobile technology, more and more expansive throughout these countries, now you can actually get money to people. You don't have to bring somebody out into the street and start distributing money. You can get money to people. And so we need to be thinking about this more. And as we think about our stress testing, this has an impact. If we can reduce the costs of these disasters, then that reduces the stress on us. We need to incentivize insurers to enter this market. We need to help them to find better ways, easier ways of getting into the market. So there's a bunch of other things for supply that was interesting, I think, and we need to think about the demand side. There's very limited awareness, and commonly what people will tell me is that, yeah, there's very limited awareness of the market and they don't understand insurance. But the reality is the biggest limited awareness, the biggest problem is that insurers don't understand the issues of this market. You don't just develop a product for Shell Oil, right? You talk with them, you understand what they need, you develop something, okay? That's what has to happen with the low-income market, not one by one by one, but in segments. We have to understand better what these people need, what they face when these risks occur, how they face them now. We need to understand those things. And from there, we can start to put things together. What we need are more public good efforts. So public good efforts that are available to all insurers and others based on work that's done. Demand work is commonly one of the areas here. So public goods, and then using that, then insurers can identify private components that they want to offer, and then they do a little research on that. And there we can help to create some microinsurance and climate risk coverage. We spent time in the Philippines. Again, I'm sorry for using the Philippines so frequently, but we have a product that we've just launched, literally just launched, which provides an opportunity for people in the United States, migrants and diaspora, to send money to the Philippines to be able to cover their family members against typhoon risks. And so I think this is incredible. But we need to be thinking more about how can we address these things and how can we do these in an effective manner. This helps us with the stress testing. It makes the stress more reduced if we have proper products. Okay, so on the demand side, we need to understand more this market and how we can access them, how we can address their issues. On the distribution side, there's limited distribution channels, especially during a climate crisis. The thing is, when we're relying on other people on the meso level, for example, when we're relying on others to get money to the lower income people, those people may have lost their own family members. Those people may have lost their own offices, their own homes. And so they're busy. And so how do we think about how do we get the funds out there? And so mobile network partnerships, mobile money are always now that we can start to address this better, getting the money out there. And so this leads us to a small thought of the need to stress test the distribution channels. How are they going to get the claims money to where it's supposed to go in the case of a disaster? It's one thing to say, okay, we paid the meso level and then we can be done, but we really have to think about how are they going to make the change for others. And I think that's really important. And then the enabling environment. What I'm finding, particularly with this work in disaster risk financing, right, there are regulatory barriers that keep insurers from being able to do the right things. There are limited actuaries to be able to calculate what these risks are. I think both Erica and Ken touched on that. We need to be working on facilitative regulatory frameworks. And one of the things that we're seeing in the disaster risk finance work is that there's not even proper regulation that says, okay, if you get this money, how does it get distributed? Who has the authority to make these decisions on the macro level? And we also just wanted to put a plug in for our UNDP Milliman Global Actuarial Initiative. We have a project now where we're working to build the actuarial profession in up to 27 different countries. We're doing this in partnership with UNDP. It's a really exciting opportunity, and it recognizes some of the issues that both Erica and Ken have talked about, and the need for actuaries. And so really, if we can think about this in ways that work to help all of us. So stress testing for the insurers, yes, we need strong insurance companies, but we need insurers and governments and donors to be working together This creates good business for insurers. It improves risk management overall for the low income, and it creates greater stability for government and communities. And one of the things that insurers take as a paramount desire, if you will, is greater stability in governments and in communities. So with that, I'll thank you very much for your patience. And those of you who did stand up, thank you. And we look forward to more compliance in some of these stress testing issues. Thank you very much.
That's great. Thanks very much, Michael. So now we can move on to questions, and we have had a few questions. Thank you very much for those. Please feel free to send some more questions to the chat box. I think it probably makes sense to start with Michael, actually, seeing as you've just been talking. Question coming in, how do you balance the commercial considerations and the impact ambition of a microinsurance product?
Couple things. How do we balance commercial and impact? And I think this is one of the beauties of microinsurance, is that you can do both. We actually call this the magical balance, where we can benefit people and create a nice business case. The key to all that is volume and scale. You have to be able to get volume. To have 1,000 clients, it's not going to do anything. And so we have to think about how can we get large volumes of clients in an efficient way that doesn't impact our admin costs substantially. But so getting to scale and finding easy ways to do that, so distribution channels. And also one thing too to recognize in so to add on to the Typhoon Haiyan example in the Philippines, one of the things that was seen very, very clearly, I don't have the numbers, but very clearly was seen that after Typhoon Haiyan came, after the insurers responded in the way they did, there was a much stronger demand for insurance. And so this also brought in some of that scale. And so always there should be this magical balance. You do that through scale, through good products, through good service, to build trust in the market, and to pay claims like they did in this example in the Philippines.
So can I just ask a question then, Mike? I mean, are you working with traditional commercial insurers to try to extend the scope of their work or the scope of their market, or are you working more with governments trying to identify maybe some more niche players to service the market that you're interested in?
Our traditional work is to work with insurance companies. It's always been my premise that the best way to get this done is through insurance companies, and helping them to go through the paradigm shift to recognize this new market and how to attach to this new market. We do a good deal of work with governments. Right now, we're doing this disaster risk financing, and so that's focused on governments, but with the other layers. And most of the work we traditionally do with governments is strictly with the regulators to make sure that there's regulations that fit with what we need for microinsurance.
Right. Okay. So you're trying to push the demand from the commercial perspective, and then working with regulators to make sure that there's appropriate control and the right conditions are there to enable those companies to succeed.
Yes. So, just simply some of the things that we work with regulators to do is, in microinsurance, we don't have agents that are licensed by the insurance commissions. There's no need for that. We have very simple documentation. There's no need for 20 pages in a life document for people who can't read, for example, right? So we're helping the regulators to break down all these kind of barriers to working with this market.
And is climate change opening, or the impact of climate change, is that opening more doors for you?
It's opening more doors, but it's opening them in a very complex way. Yeah, it creates an altered area for us to be working in, but it's quite a challenge, challenge.
Okay, great, thanks. Well, let's see if there's more questions that come in on the chat box, and for now I will deviate back to I think probably Ken. Ken, there's a question coming talking about an event-based scenario for long horizons up to 30 years. How do insurers decide the timing to apply the stress at? And there's a corollary, but the corollary is looking at change of parameter type, where climate metrics such as CO2 emissions and temperature are well established. How do you translate that to an actual stress parameter? Is it done based on statistical approach, or is there a lot of expert judgment involved in translating that into a stress scenario?
Okay, maybe let's just address the event-based long horizon question first. So yes, there's a good point here as to, when do you apply the stress, especially if the horizon is 30 years long, right? So it depends on the regulations, the scenarios prescribed by the regulator. For some of it, it's quite clear cut. They want you to put in the relative disasters at different point. For those that doesn't, right? So based on what I see, they will just translate this sort of catastrophe, apply it with a frequency such that it kind of equals out that every few years there will be one disaster, but then the disaster get more and more severe over time because of climate change. So it's kind of incorporate the large losses but normalize it into more stable stream of losses coming in, right? So that's how I see it. I guess to a certain extent, if you are using catastrophe modeling, that is how they would translate the catastrophe models into long-term impact as well. It's not just one event that will happen in year 35, but it's like how the whole package of things are coming together, I would say. The second part, in terms of change in parameter, whether translating into stress parameters is purely scientific or statistical or judgmental, or whether or not it's credible, I would say based on what we know about the climate change based on what we know about the climate change, that's just I believe it will be a half and half, statistical and judgment, right? There are scenarios where I've seen people try to fit a GLM in terms of whether the frequency is depending on temperature and sea level rise, to find the correlation between it. And then, even though you fit the best GLM possible, it's credible from a statistical approach, but does it reflect the real scenario? I doubt so, right? So to a certain extent, it's a mixture of both, right? How do you show causation and correlation? There's just so much you can do about it, right? And I guess the bigger issue here is that it's not about finding the perfect solution or finding the answers that answers everything, but it's more like based on whatever limited information, whatever things that we can do, and whatever judgment we have at this point in time, what is our view and how are we going to react it? How are we going to incorporate it into a wider ERM framework? I think that is more important to me, right? I don't think the regulator expects you to know the answer and to demonstrate causation, but I guess what the regulator wants you is to prompt you to think about it. Okay, this is what I think based on the limited information I have. I'm going to work this way to mitigate it. I'm going to avoid this. That would be the bigger outcome, I think.
Okay, thank you, Ken. We have a few more questions and we only have a few more minutes left. And Erica, you have got the bulk of the remaining questions. So I'm going to flick through them quickly. So maybe if you could be concise when you reply. First question, what's your perspective on qualitative versus quantitative assessments by regulators in Asia?
Thanks, Richard, and thanks to the audience for the questions. I would say indeed, both regulator will look at will look for both from the insurance company. However, I think it depends on the size of the insurance company. For example, if you are a smaller company, the regulator will expect you to maybe have qualitative analysis at the beginning is already adequate. But for bigger companies, they may expect at least you need to do some quantitative analysis. And I would expect regulator will ask the company to start with a small step at the beginning, use a very simple approach to address the issues. And then later on year, you should show improvement on how you assess and manage your climate risk. I hope it answers your questions.
Thanks. Maybe this one is connected. So the NGFS scenarios, there's a growing industry view that they may understate the climate risks. And there was an IFOA paper that identified shortcomings in those scenarios. What's your recommendations regarding whether these scenarios are adequate or not?
I would say indeed, my understanding is there's a 1,000 or maybe even 10,000 paths that will go towards in 2050 you will achieve net zero. There's a lot of things that are happening in the world, like maybe tomorrow our government will have a new carbon emission guidance for certain industry. Maybe 1 year later we will have a technology advancement in whether to convert CO2 towards oxygen, or it will automatically maybe solve the climate issues. We never know what will happen in future. I would say what is important is to really understand the limitation of the climate scenario that you're using, and also while you're adapting the climate scenario for your own company, maybe you can also make some small changes, in particular if it is part of your OSAS process instead of part of an industry-wide stress testing. I would expect later year on year, industry will lobby with the regulator on the good climate scenarios that should be used for stress testing purpose. And also, in Europe, even they start much earlier than us, and even now until 2023, we still cannot have so-called best practice being widely accepted by all the regulator or maybe all the insurance company and all financial sectors as a whole, which we should adopt and different regulators or different insurance company are still using different approach to address these issues. But happy to discuss it.
I'm going to squeeze in one more, which is question came in as Ken was doing his presentation. The question came in: do we have a similar detailed case study for life insurers? Erica, you're on the life side, so maybe you could just very briefly respond to this question.
Okay, thanks, Richard. I think for life side, I would say that for life insurance company, our focus is not really on the catastrophe models. Our focus will be more on the transition risk that is on the asset side of the balance sheet. Indeed, I would say that in a minimum, in particular in our European office, we have helped a lot of life insurance company in doing stress testing or maybe climate risk identification and assessment for life insurance company. Of course, a different approach will be adopted because we are looking at transition risk instead of putting a lot of focus on the catastrophe or maybe physical risk of the climate risk. But we have quite a lot of publications on this topic. Happy for you to share with you if you are happy to email me.
Okay, great. Well, I think we're out of time. It's 2 o'clock Hong Kong time at least. Lots of interesting stuff there from the 3 panelists. I think definitely going to be interesting to see how regulation develops both on the life, non-life and microinsurance side, and also how insurers are going to respond to these challenges. I mentioned earlier that this webinar was being recorded, and the recording will be available on the Milliman Climate Resilience Initiative website. I recommend you to all sign up for that, and you can find lots of other useful information on climate risk webinars, that type of stuff up there. So that's the end of our session today. Thank you very much indeed to all of our speakers, to Erica, to Ken and to Michael. Thanks to everyone for their questions. Wish you all a good day or a good night. Thank you.
Thank you.
Thank you very much. Thank you all.
Bye.